Nick Meta is a managing partner of Studio Legale Meta. They have offices in Bari, in Puglia, the south of Italy, as well as in Philadelphia. Their studio has been around for generations, multiple generations. And Nick and his law firm, they provide a full suite of services for US nationals who are looking to relocate to Italy. So pleased to introduce Nick Meta and just a couple administrative matters. I know you guys will have questions, but please hold them until the end of the presentations because some of them might get answered. Then we will have ample time for Q&A at the end. And then ideally, nobody leaves here hungry because we'll have time to also get one-on-one sessions, mingle outside, and special thanks to our host, Ely, who has provided enough food for us to not leave hungry. So grazie mille, piacere, and let's get started.
Yeah, thank you. There you go. All right, thank you. And who is going to be my little, my own? Okay, I'm going to be my own helper tonight. All right, look at that. All right, so I need to be on that side, I guess.
Oh, that's okay. I can even do it.
All right, I'm the one on the left, right? All right, so while we try to figure this out, my name is Nick Meta, and thank you very much, David. Thank you, Relocate, for having me. I'm an Italian lawyer. My law firm is based in Italy. I am based here in the US because our largest share of clients is based here in North America, especially the US. So we focus on helping people move into Italy, investing in real estate in Italy, acquiring citizenship, and estate and tax planning. These are the main areas of practice. So to go to Italy, obviously you need some requirements. Before getting into the details, I'd like to get to know you a little bit to be more focused with my presentation. How many who has Italian citizenship here? Okay, not many. Anyone who is a European citizen on the EU. Okay. All right, good. And anyone who has a plan to move to Italy anytime soon within the next year or two? All right, good. Perfect, thank you. All right, so as you can see, all right, I know what it says, so just listen to me, I guess. So in order to go to Italy, if you don't have citizenship, Italian citizenship or European citizenship, you need to worry about immigration. Having immigration status. Having immigration status, it means having the permit, the authorization to spend in Italy more than 90 days, which is what your American passport, I guess, kind of assume that you guys are all American citizens. So in order to be in Italy, you can be in Italy on an American passport for maximum 90 days within a period of 180 days. So if you want to stay longer than that within Europe, actually, not just Italy, you have to get an immigration permit. And to get an immigration permit, actually, the first step is to get a visa. So it goes, get the visa in the US, where you live. Once you get the visa, you can go to Italy and apply for an immigration permit. Now, in order to get a visa, you need to have a specific reasons. It's not just you go to the consulate and ask for a visa. You can ask for a visa if you qualify under one of the categories that are allowed. For example, if you have enough money and don't have to work and you can sustain yourself and you're not going to be a burden for the Italian social system, and you can prove that you have sufficient passive income, and which is the threshold is not particularly high. So if you have like up to like 31,000 euros or about $35,000 in passive income a year, you might qualify for that visa. It's called Elective Residency Visa. And it is actually a very flexible visa you can apply for in order to get to Italy, to get a permit to stay in Italy longer than 90 days. As an alternative, that visa doesn't allow you to work in Italy though, because it's a visa that is for people who don't have to work. So some people call it retirement visa because when you're retired, you don't work. As an alternative, if you want to continue working, last year they came up with the digital nomad visa. So if you can work remotely, you can prove that you have some high skills and in your profession, what you do, and you prove that through several options. One of them is by showing that you have a bachelor degree. And if you don't have a bachelor degree, you show that you have a certain amount of experience in your field. So if you have worked for 3, 5 years, depending on the circumstances, that would replace the need of showing that you have a bachelor degree or higher level of education. So digital nomad visa is actually very, very flexible. And it's another visa that is pretty easy to obtain. So once you get that visa, you can go to Italy and work for an American company or your own business or an Italian company. It doesn't have to be a foreign entity. You can be a self-employed or you can be an employee. So these two options allow you to go to Italy and live there permanently. Another option is the investor's visa, and some people call it golden visa. So you, however, have to come up with a pretty high amount of money to invest in an Italian legal entity, an Italian company. And the baseline is 500,000 euros, so about 600,000, $550,000 approximately, which is a lot. Or if you invest in a startup, it might be 250,000 euros. So not particularly enticing to most people. So many times the elective residency visa offers more flexibility because it's much more affordable. And then if you want to transfer to work with a subsidiary of the legal entity that is currently employing you in the US, for example, you work for a corporation that has an Italian subsidiary, you can get a corporate visa or a intra-company transfers visa. So you could do that too. And then there are some other options that are less frequent. Blue card when you have very high skills and you get a European contract to work with an Italian company, and you can get the blue card. Or if you want to go study in Italy, you can get a student visa. Thank you. We talked about citizenship as an option. If you don't have citizenship, there is the possibility to go to Italy without a visa and prove that you have entitlement to Italian citizenship. For example, because your parent or grandparent was born in Italy, or because one of your parents lived in Italy before your birth for at least 5 years now. The law changed less than 2 months ago and actually is under discussion because the law change happened through an executive order by the government who decided to change the law suddenly, overnight, literally. So now they're discussing in the parliament whether to keep it as it is or change it a little bit or toss it completely. So we'll know by the end of the month because they have 60 days to decide what's going to be. We believe that it will go through, and unfortunately, it is way more restrictive. So if you were planning on applying for citizenship, I would say there are a lot of moving parts right now. Wait 2 weeks, and then on our firm's website, you will find a lot of information about the progress of this new law discussion. I will skip some of the details because we don't have a lot of time. But if you happen to fall in love with an Italian citizen, that would be an easy way to get a pass too. You don't need a visa at that point because even if you're already in Italy and you get into a marriage or civil union, you automatically are entitled to permanent card, so permanent immigration card, and then the naturalization after you are in Italy for 10 years, you can become a citizen. Or if you are a European citizen, and some of you here are European citizens, if you live in Italy for 4 years, you are entitled to citizenship. All right, so things to remember. Going to Italy, it's a lot of fun, good food, weather, culture, lifestyle, but unfortunately, when you become an Italian resident, there are tax implications. So Italy adopts the worldwide taxation system like the US, but unlike the US, if you are not a red tax resident, you are not taxable. So there are ways to enjoy living in Italy without that tax burden. And there are also ways to actually spend a lot of time in Italy without becoming an Italian tax resident. There are several situations that might trigger a tax residency assumption. However, depending on the circumstances, you can avoid that tax residency qualification. And with the US in particular, Italy has a treaty against double taxation that might help you claiming that you are a US tax resident instead of an Italian tax resident, even if you spend in Italy more than half of the tax year. Also, if you go to Italy, right now, they are running several tax programs to encourage people to move to Italy, and where they will offer lower taxation for a certain amount of years from when you move to Italy. For example, there is an option to move to small towns in southern Italy, mainly, where they say if you move to those small towns, meaning under 20,000 people, a population, you will be taxed only 7% on whatever income you earn outside of Italy. 7% is extremely low compared to the standard national rate, which is 43 national and about 2-3% local. So instead of 46, 47%, you pay 7%. So, however, it's limited geographically. If you are lucky enough to have significant income in outside of Italy, you can pay 200,000 to Italy as a one-off per year and not worry about anything else. So you tell Italy, okay, I'm a new resident. Here is 200,000, and I don't have to report or declare anything else, which is sweet. But to make sense, you would have to have income outside of taxable income outside of Italy, ranging between 650,000 and a million, depending on the type of income, because some income in Italy is taxed according to ordinary brackets I was mentioning, and some income is taxed much less, like 26, sometimes 11%. And then there are some, if you want to take it easy and take advantage of the digital nomad and work a little bit while in Italy, you might qualify for the small business program. So if you make less than 85,000 euros, which is approximately $100,000 now, you only pay an effective rate of 11.7%, which is also very good compared to the 45 otherwise. So and I cannot go too much into the details or the tax options. Once again, on my firm's website, there's a ton of information. And I'd like to address the estate planning, because going to Italy also has very significant estate planning consequences. Once you become an Italian resident, the Italian inheritance law will basically define you as an Italian resident also for estate tax purposes and for inheritance purposes. So Italy will say, if you live in Italy, Italian inheritance rules will apply to your estate worldwide. And in Italy, there is forced heirship, meaning in Italy, when you live in Italy, Italy expects you to leave some of your estate to some family members, spouse and children in particular, sometimes also parents. So if you don't want that to happen, you can make a will and elect through your will your US law to apply to your Italian estate. So there is that flexibility you need to be aware about so that you can prevent Italian forced heirship rules to apply. Because otherwise, especially if usually in the US, we are used to mirroring wills, everything goes to the spouse, and when the last spouse goes, everything goes to someone else, children or whatever. In Italy, that doesn't happen or can be challenged. So you want to make a will where you say, I have US citizenship, therefore I elect US law to apply to my estate, also the one in Italy. And if you have more than one citizenship, like some of you here do, you can choose which citizenship to govern, which law to govern your succession, your inheritance, which is actually gives you a ton of flexibility. And in Italy, that actually works very well. It doesn't work the same way in some other countries like France or other European countries where forced heirship is considered public policy, so it cannot be overridden by choice. It is either that or nothing. In Italy, the Supreme Court has established that actually you can override it. So that gives you flexibility. And then there is another aspect that is very often ignored, which is that you once you move to Italy, you need to, in my opinion, be concerned about proper power of attorney, estate planning documents, medical directives, because the paperwork that you have prepared in the US might not have legal validity in Italy. Because in order to be valid in Italy, a document needs to refer to Italian law, to Italian legal language. And so many times people come to us with an American power of attorney and say, you know, my spouse unfortunately got incapacitated. I need to sell the property or I need to do this or that with the bank. And we tell them, unfortunately, that power of attorney that was done in the US cannot be used in Italy because in Italy, the Italian tax authorities or Italian register of deeds or whatever wants a specific language in order for a representative to represent someone else. And so if you intend to stay in Italy for a significant amount of time, I recommend having power of attorney and medical directives in place in Italy. And inheritance taxes are very low in Italy, so you don't have to worry too much about it. And there are two things that I would recommend keeping in mind about inheritance taxes. One is that your Italian estate will be always subject to Italian inheritance tax, regardless where you live. So if you decide to buy a home in Italy, or perhaps some of you actually own a place in Italy already, just know that regardless where you live, the transfer of that property to a beneficiary will be subject to Italian inheritance tax, which goes from 4% to 8%, which is not a lot at all. And actually, the share that goes to your spouse or child is inheritance tax exempted up to 1 million of value. So that's very good. Last thing I wanted to mention is about trust. In the US, we are used to prepare a trust and wrap all our estate into a trust for simplicity, to avoid probate or to make the transition of the estate easier. In Italy, it's the opposite. You don't want to use a trust, at least now, because Italy doesn't have trust law. Italy will acknowledge the existence and validity of foreign trusts because signed a treaty saying that they do. However, when it comes to the tax office to handle the tax aspect of trust dynamics, it is extremely penalized, unfortunately, just because it is something that Italy doesn't have and the Italian tax authorities don't know how to handle. And very, very often, transfers of assets through trust end up in tax courts, and it gets expensive. So Italy has many other ways that belong to the Italian civil law system that might allow you to achieve exactly the same result that you would achieve in the US through a trust. So it's just a matter of understanding what your goals are and determining the right tools in that jurisdiction to achieve those goals. So just don't give anything for granted or do not go to Italy with the assumption that whatever works in the US works in Italy. That's the bottom line. And there's a ton of misinformation online. Most of it is based on good faith from people who have had their experience and think that their experience is the law or the rule. But there are so many different situations that might alter a strategy or a scenario that I recommend that after your research, you talk with a professional to really go through your strategy, go through your goals, and advise you properly. That's pretty much it for the time that I have at my disposal. Thank you very much for listening, and I'll be available later for a Q&A. Thank you. Who gets this now?
You're going to pass that over. So this is Nick Castillo. Nicholas Castillo is a founding partner of Relocate International. He's a licensed CPA and advises clients on a lot of cross-border matters in major EU jurisdictions, including Italy. So next up is Nicholas Castillo.
Right. Good to go.
And everyone can hear in the back? Okay, good. There's a lot of action here, so just making sure.
All right, everyone. Thanks for having us. It's a warm welcome that we've had here in LA, and I'm happy to be able to share this information with all of you. So I'm going to be talking about crafting your U.S. tax strategy when you move from California specifically to Italy, because that does affect the overall situation in a lot of ways. So first, really quickly about me, I started my career in Miami doing international tax work. Rose through my days of public accounting. I worked for private industry for a little while before becoming an expat myself. My wife and I, we live in Spain, and now with this company with Rook, we serve expats who want to live abroad. They're Americans, maybe with a business, maybe with some real problems that we need strategy to solve, and that's where we provide a lot of value. So to start off and level set, can I see a raise of hands for anyone who is a U.S. citizen or green card holder? Okay, so almost 100% of the room, right? So the very quick conclusion that I want everyone to have is that as a U.S. citizen, when you move out of the country, you live in Italy, you live for as long as you want to say you live there, you're filing a U.S. tax return. And so we have a U.S. citizenship-based taxation situation where if you have the citizenship, you should consider filing. Now, the tax filing dates are very similar to when you are in the U.S., with some modification because the IRS gives us some leeway. So first of all, April 15 is let's call it the tax deadline as it is officially in the U.S. Now, that remains the time to pay taxes if you owe anything. But however, you have an automatic extension to file your tax return for 2 months. The idea is that the IRS knows that if you're in Italy, you're in another country, you're filing a local tax return, you might need extra time to gather your documents, and this gives you that time without rushing to the deadline. And so we can still extend the tax return filing to October 15, 6 months from April. That gives us even more time because even then with the 2-month extension, sometimes we need more time to compile all the Italian tax returns and all that important information. And then let's call it a last resort extension to December 15th that we usually want to avoid unless there truly is an emergency, because the IRS requires that it comes in handwritten by mail, and we don't want to do that from Italy or from anywhere else in the world. So in general, you should think that you're filing a tax return while you are an American abroad, but the thresholds are as follows. So if you are American married to a foreign spouse, so your spouse does not have a U.S. citizenship, and you have to file if you make $5 or more. So the threshold is very low. Similarly, if you have self-employment income of $400 or more, you have to file and report that income. Or if you want to have the refundable child tax credit on your return, if you have children, you can still get that credit even if you live abroad and you don't want to miss out on that. Otherwise, if none of these applies to you, then you have to make more than $14,600 to file, to be required to file. Now, yeah, let's go. Another important filing that is really easy to miss, but it comes with heavy penalties if it is missed, is the FBAR. So the FBAR stands for the Foreign Bank Account Report, and this is a product of FATCA, of some of the recent laws where the government is trying to address money laundering and people not reporting income abroad. And effectively, if you have cash of $10,000 or more in non-US accounts, So you open a bank account in Italy, you have a checking account, savings account, brokerage account. Then you are required to disclose that the account exists. Here's the account number, the balance, and you do that every single year by October 15th. It's also important if you have a business, you're freelancer, if you have rental income that you do owe tax in the US, that you follow the quarterly tax estimated payments, because that schedule still applies. Otherwise, you might face penalties and interest. Now, when I say that we're filing as a US citizen abroad, that means it does not mean that we're always going to be paying tax as a citizen abroad, because most likely in a place like Italy, you're paying taxes there. So to avoid double taxation, there's two main provisions in the US tax code that help us to avoid double taxation. So number one is usually the end all be all, it's the foreign tax credit. Effectively, if you're in Italy, you're paying a high rate of tax, you are able to say to the IRS, hey, I'm in Italy, I have foreign source income, I'm paying taxes already on that, I'm not going to pay it again in the US. There could be a situation where you have the 7% tax rate in Italy, you have, let's say, a 12% tax in the US on your income, and you utilize the foreign tax credit to say that 7% applies against my 12, so you pay in the US 5%, that difference. And the idea is that if the Italian rate is higher than the US, you pay nothing to the US. If the Italian rate is lower, then you top up your tax in the US. So you end up avoiding double taxation, although you might pay to both countries at some point. Now, the other option is the foreign earned income exclusion. This one is, let's think of it as a catch-all for when the foreign tax credit fails. If you are abroad in Italy or effectively you're outside of the US for most of the year, you can claim up to $130,000 of your income as tax-free. Now, this means it has to be foreign earned, so it has to be income that you've generated while outside of the US, and it has to be earned, right? So wages, salary, business profits. This doesn't count with pensions, capital gains, dividends, interest, etc. But it could be a really beneficial provision to use because that's a significant amount, and each spouse can take up to $130,000. So there's pretty significant tax savings there. There's also a quick tidbit to say about the child tax credit, which although you are, when you're abroad, eligible for it, if you have children, you have qualifying dependents, we are not allowed to take it if we use the foreign earned income exclusion. And so that creates another planning opportunity here to make sure we take the most benefits. Now, when you are moving from California, you have the California tax rules to address as well. And given the state system that we live in, California does have its own rules that we have to follow. Number one, and one of the most important ones, is this concept of domicile versus citizenship. So if you are domiciled in California now, you live in California, your life is here, then even if you move out of the country, California may still make a claim that you are domiciled, you still owe tax in California. And so there becomes an important situation where we have to make sure that we demonstrate you have intent to leave California for a permanent, if not semi-permanent, time frame, and a few other things that we have to consider. There's a lot to talk about on domicile, but in general, it's something that we want to talk about before you move out abroad, because there are a lot of mechanisms to avoid domicile. Now, as you may feel when you're in California paying the taxes here, there are a lot more strict rules about a lot of deductions. Now, the foreign earned income exclusion and foreign tax credits are not allowed in California. So you move abroad, let's say you're in Italy for 2 years, you have all this income, you're able to use the foreign tax credit on the federal return. California does not let you take it, so you're still on the hook. So one of the things that I like to say is that in California, the best tax planning mechanism when you move abroad is to make sure you don't have that domicile and that we break free from that. Similarly, California does not allow us to use the tax treaty positions, which can be really important for certain items of income. And still, it's when you involve California tax, you're playing on hard mode. Let's go next. So one of the common questions is that if I have Italian citizenship, how does that affect my US taxes? And the quick answer is that Italian citizenship or EU citizenship in general does not change your tax situation. If you're a US citizen, you have to follow these rules. And you have to pay, or you have to consider paying taxes in Italy if you become a tax resident of the country, which is a slightly different situation. So when do you become an Italian tax resident? So when you spend the first year that you spend 183 days in the country, you are generally considered a tax resident for the full year. It's an all or nothing rule. So you move to Italy on February 1st. For that whole year, you're going to be considered a tax resident, even for the income that you generated in the month of January. So this doesn't really change, like I was saying before, your US tax filing requirements, but it does change some things like your filing deadlines and the forms and the credits you're able to use. One of the good questions that we should always talk about before the move is whether you should sell your house in the US before you move. Should you sell it during the move, or should you keep it and rent it out? So there's a lot of things that come into this. One of the things I say is don't sell it if you might return, because you're doing all this this work to come back to that house. And it would be nice to keep that house, right? If that property is in California, that does change the situation because you will have a California tax bill. And there's also, will I rent the property out? There's generally renting a property in the US is a tax benefit in Italy. So it's not a bad decision to go that way if you have a property here when you move. So one of the important things is think about when you sell your property, you have a potential US tax bill, potential Italian tax bill to worry about. So in the first scenario that I want you to think about, it's ideally the best one, where you sell your house in January. Sorry, other way around. First one is the lesser option. So you're selling your house in January and you move to Italy in January. So you're a tax resident in the year that you sold the property. Now, because you're a tax resident, that is a transaction that you have to report to Italy. Now, Italy does give you some tax benefits. If you've lived in the property for 5 years, been your primary resident for 5 years, it's tax-free. Similar to the US rule, where if you lived there for 2 years, it's tax-free. But now imagine a situation where you've only lived in that house for 3 years. You sell the property, you are exempt from US tax on that property, but you're not free from Italian tax. And so you have a situation where you're paying Italian taxes on your US property, and that can become a really tricky situation to report and to pay that tax. And so ideally, if we're planning this out, it makes sense to sell the property before you become a tax resident. So let's say, like in scenario 2, you wait until July to move to Italy, and you sell the property before that, during that year, so that you don't report it to Italy. Let's go to the next one. So let's get into the Italian tax rates. So don't be afraid of the numbers, because right now they are, it adds up very quickly. But in general, in Italy, your tax rates rise really quickly. You fall into the highest tax bracket very fast. So earnings over 50,000 euros are already taxed at 43%. Social taxes are still something you're on the hook for in Italy a lot of the time. So that could be 23% or more. So you're looking at a 60-something% tax rate while living in Italy and, let's say, not doing anything extra to plan around those taxes. So first, let's dive into that social tax section, because as an American who is doing a freelance activity, self-employment, freelance, contracting, being an independent contractor, you are subject to American Social Security tax, even if you commit that activity while abroad, right? So the American tax rate for Social Security and Medicare tax is 15.3%. The foreign earned income exclusion, the foreign tax credit, and tax treaties, the income tax treaty that you usually hear people talk about online, those do not affect self-employment taxes. So it doesn't matter how much tax you're paying in Italy, you won't be able to offset the self-employment tax just based on that. So that's really important because that's very different from other countries in Europe. So instead, we rely on what's called the totalization agreement. This is a Social Security agreement between the US Social Security Administration and the Italian that says that dual citizens who are American and Italian citizens get the choice to contribute either to their US social system or the Italian. So you can choose to pay the 15% tax in the US or the 23 or more tax in Italy. Generally, I know which one I recommend to pay. If you are an American citizen, so you don't have an Italian citizenship, then you have to contribute to the US system. And so that is a really important thing to keep in mind. It's very different from other countries. Now, when you're moving abroad, aside from the social tax, there's a few things to think about, especially if you go with a business. Now, I like to remind people that because of the American citizenship, American entrepreneurs have a little bit more opportunity, actually. It's not a detriment to have the citizenship while being in Italy and running a business, because there are options to set up a structure, to set up a business that is globally efficient in both countries. And so there's four main, I call it pillars of having a business while you're in Italy, having this global structure that I won't get too much into, but they have to do with where you're providing the services, where your clients are, how you price them. Are they priced fairly versus, the averages in your country, in your area for your industry? And one of the most obvious ones that we hear a lot online about is the legal entity type. So LLCs, corporations, S corporations, that's an important distinction too, because Italy will treat those entities differently. Now, what I usually recommend is, and this changes for everybody depending on your situation, but what happens a lot is you have a US entity, perhaps an LLC, that exists in the US for the flexibility. So you're a US company, you have US-based contracts, US banking, that it gives, it's familiarity for a lot of us. Then skipping to the third one, we utilize the local tax regimes of Italy. So as Nick was saying, there are several tax incentives for trying to bring people into the country. A lot of them give business owners, freelancers, opportunities to pay 15% tax, the 7% if you're in the South on retirement income. But and also there's one that's 50% for being an employee. So there's a few of those that we can take advantage of based on your situation. And then to the extent we want to do more, we can pay dividends that are taxed at a flat rate of 26%, which again, in the grand scheme of things, with the 43% tax we're looking at, it's not a terrible idea, not a terrible rate. Now, I know I talked a lot there. I have an example here to try to illustrate that a little bit better, and use the numbers that make it sound a lot nicer. So let's assume that I am moving to Italy. I have a business where I'm going to be generating 100,000 euros of profit. So running that with no planning, I'm just going to be in Italy and set that up and report that to the government. The Italian tax comes out to be a 35.6% effective rate. So my income tax rate, they're 35%. It's already starting pretty high. Now, I'm an American. That's a freelance income that I'm generating. So I owe the US self-employment, US Medicare taxes of 15.3%. And I'm going to choose that instead of the Italian social tax because it's a little bit better. And that's easy to do on the tax return by itself. But it's still a 50.9% tax rate. It's significantly high. But let's say I plan a little bit. I set myself up in Italy as a freelancer under a special tax regime called the forfettario, effectively giving me in Italy a 15% flat tax up to 88,000 euros. Now, just thinking about that, out of that 100,000, I pay 88,000 to myself. I'm paying 15% or 13,000 euros. Great. That covers a lot of my income. And the remaining 12,000, I'm going to pay myself as a dividend, which is going to be taxed at 26%. That gives me a $3,000, $3,120 or euro bill. And then, sorry, one more second. Let's go back one more. Yeah, no worries. So the self-employment tax remains the same because that's still a good situation. Now, adding all this up, this tax structure results in a 31,000 euro bill or 31%. So 20% tax savings because we thought about it in advance, we planned for it, and we registered in this way. So again, I can't stress the importance of planning in advance enough. So it's important to have these conversations. Now, some other issues to be aware of in case this is part of your situation is first the PFIC regime. So this stands for Passive Foreign Investment Companies. Effectively, if you have a non-US mutual fund, the IRS penalizes that. So unearned profits are taxed at the highest possible rates, and it's generally a tax filing nightmare for most. Foreign trusts or gifts from foreign people. So if there's an Italian trust, which likely doesn't exist, but let's say you have a gift from your nonna who's not a US citizen, that has to be reported or you suffer huge tax penalties. Also, there's a foreign corporation regime where if you or any other Americans own a foreign business, you have to report that and potentially pay US tax on those profits. And then lastly, if you have a business activity that's like a freelancer or a rental property, you have to report that as if it was a foreign branch of yourself, which is a funny concept, but that's the way the IRS code is written. And then next. Okay, so the key takeaways, the three things that I want everyone to kind of think about as they're considering their tax situation. So the tax calendar is really important. Tax filing, tax payment, estimated tax payments, that's all really important when you're moving abroad. So keep that in your calendar and work with someone that reminds you about that. If you own your primary residence in the US, what to do with that, how to structure that transaction if you're going to sell it, and what's the right way to keep it around if you wanted to. And then lastly, becoming an Italian resident has a lot of tax pitfalls and opportunities. So it is really helpful to talk to a cross-border advisor and have all that sorted before you go and run into those problems and stress out about it. So that's enough for me. I'll be around for the Q&A, and also I'm happy to chat after and follow up. So thank you guys for listening.
I see people taking pictures of the screen as well. We're going to be giving out.
I have it.
After the next business day or so. So everybody, the bag shot with his room, we'll be sending out the entire presentation, so you'll have all of this for your results. Next up is Alexander Olga, who runs a boutique private wealth management company We've
It's a
been
Mac.
cross-border
Yeah.
space advisor, specifically U.S.
Let me make sure I put it the right way. One
major
second.
EU destinations, such as Italy, Portugal, Spain, Malta, and France. And Alex actually lives in Florence, so I'll leave it to him to talk about financial planning strategies and what you should be thinking about for your next volume in Italy.
All right. Hey, everyone. As David said, I am Alex, and we're going to talk a little bit about financial planning for people that are considering becoming Italian tax residents. So I'm going to try and keep it short and gloss over some of the topics that we already covered. There's a little bit of redundancy, but we're going to touch just very briefly again on what constitutes tax residency, a little bit about the taxation of Social Security and retirement accounts, and how that works in reality, capital gains taxation, and then just very briefly on how your relationship with US financial institutions like banks, custodians, retirement account providers would change after you move. Okay, so we covered this pretty well already, but Italian tax residency is dependent on a few different factors. The primary factor is how much time you spend in the country, so 183 days. But there's also the concept of if you are registered in a comune in Italy. So a comune is like a town. If you're actually registered in a town, when you become tax resident in it, when you immigrate to Italy, you typically would register in a town in order to avail yourself of services like public health care. So the way that you actually get access to the public healthcare system is registering in a town, and then they assign you a doctor. Up until about November, just that act alone, regardless of how much time you spent in Italy, made you Italian tax resident. So now you can kind of rebut that principle, but registering in what's called the anagrafe, in the comune in which you live, is also another factor that can make you tax resident. And then there's also this idea of, if your center of family life or economic activities in Italy, if you run a business or if your spouse and children are in Italy, well, you're probably tax resident in Italy. I think there were quite a few famous cases of, MotoGP drivers and F1 drivers that tried to say they lived in Monaco, and then they posted Instagram stories of them with their wives in Milan, with their kids to go to private school in Milan, and made it a little tricky. Yeah? Oh, sorry, just come on in. So your visa status and immigration pathway actually affect your tax situation. So this is kind of important. As we said, it's an all or nothing tax year. So deciding when you're going to move is important in understanding, are you going to be tax resident in that year? So there's a scenario that could arise when you move in February, you become tax resident and enroll yourself in the anagrafe in February, and things that you did prior to moving in January would be taxable in Italy in that tax year, even though you might still be here in LA when you made those transactions. So that's really important to understand this all or nothing nature. It also means if you move in September, nothing for that tax year may be taxable. So there's some planning that can be done around that. All right, let's move on. So as we talked about, Italian taxation, income tax is payable on worldwide income. So we get this question all the time. I work in the US, I have a business in the US. Why do I have to pay taxes in Italy? Because that's the tax code. It's how the US tax code is written, the French, Italian, British. So it's very consistent with every other country in Europe. So Social Security payments would be taxed by Italy at Italian income tax rates. So there's a double taxation agreement that mediates which country gets to tax various different income streams or transactions or your asset base as a whole. And the double taxation agreement gives Italy the first right to tax your Social Security at Italian income tax rates. The same thing is true for 401k or IRA withdrawals. So if you move to Italy and then you make a distribution from your IRA, Italy gets to tax it at their income tax rates, at their scale, which can be pretty heavy. So over 50,000 euros, you're into the 43% marginal tax rate. So, we do think California is high. We all think California is a really high tax jurisdiction. The difference in Italy is just when does that highest marginal rate start, right? For it to be 50,000 euros, for some people, that's just Social Security and a supplemental IRA distribution in retirement. So it can feel heavy in that in that way. Roth IRAs are not tax-free. That's pretty consistent with most other countries. That's really an American thing, that Roth IRAs are considered tax-free. Think of them as a taxable brokerage account in Italy. So you don't get to withdraw your money tax-free. Like we talked about, capital gains tax is a flat rate of 26%. That's also applicable to interest and dividends. So interest is not income taxable. It's a separate bucket. Okay, so this is where we start getting into the weeds a little bit, and I'll keep it pretty high level. But as Nick mentioned, if you have foreign mutual funds from an American perspective, the IRS doesn't like it. The same thing is true in Italy. If you have American mutual funds or ETFs, the Italians consider that non-harmonized with their tax code. And instead of taxing you at capital gains tax rates, they'll tax you at income tax rates. So they'll add any realized capital gain on top of your income, and then you get to that 50 grand and the 43% rate pretty quickly on top of your other income. So this can feel really foreign to us. And it's really important to understand it's only relevant in a taxable brokerage account. And an IRA or a 401k, it's not relevant. You can still make transactions and there's no tax consequence, just like you can in the US. But if you've got a taxable account and you have, let's say an ETF that you've built up gains in over 30 years, if you all of a sudden move to Italy and you realize those gains, they could be taxable at up to 43%. So there's just some pre-planning that would need to go on around that. Dividends and interest, even from those non-harmonized funds, are still taxed at 26%. So it's just on a capital gain. So here's, we've presented a lot of problems, right? So here's some solutions that can kind of help to alleviate your tax burden. So one idea, and we do this very commonly, and it's very widely preached advice for Americans moving to Europe in general in a lot of places, but distribute money from an IRA while you're still US tax resident. So, and that can even be in the form of a Roth conversion. If you look at what your highest marginal tax bracket is here in the US, your California tax resident with California state tax, and you compare that to 43%, it's worth looking at, should I distribute even what might be not a very meaningful sum, but it could matter because you could create some tax efficiencies of even like 5–10%. And if you can do that and you have a pretty long runway, so you've got a couple years before you're moving, you can really try and take advantage of your remaining US tax years to lower your effective tax rate once you get to Italy. We kind of refer to it as trying to lower your lifetime tax bill, right? You might not feel the effect of it immediately, but you would feel it in the future in Italy. Again, going back to the non-harmonized funds, try to realize capital gains in the US. If you think you're going to be in Italy for a long time, it might make sense to realize some gains before you move so that you're not subject to that non-harmonized funds regime. And individual stocks and bonds are the most tax efficient way to structure a taxable investment portfolio. And that's very true, in Italy and in a lot of other jurisdictions, because if you think about what they are, everybody knows what a stock is, right? Everybody knows what Microsoft stock is. I grew up in Seattle, so I always use Microsoft. But so with Microsoft stock, you know that that's taxable at capital gains tax rates. A mutual fund is constructed as a legal entity in one specific jurisdiction. And that's why it feels foreign to the Italians or to the Americans. Another idea, just delay filing for Social Security so you can create more room in your income tax brackets. So if your financial plan isn't dependent on Social Security income, you might want to delay it and take money from an IRA instead while you live in Italy, because then you can try and maximize the lower tax brackets that you have and maybe the first few years that you're there in retirement. But I think, as Nick mentioned, it's really important to consider how you structure earned income. It's important to plan ahead. And we say try and give yourself 18 months to 2 years before you move to Italy to try and put a plan in place. Just give yourself a runway. Not everyone's planning is dependent on being tax efficient, and that's fine. That's, if that's you, then you're in a great position for Italy. But if you're worried about it, try and start planning as soon as you can. So just one word on this, because we see this relatively common. There are several banks and institutions that when you move abroad, particularly when you move to Europe, and even more specifically when you move to Italy, they don't want to keep you as a customer anymore. This has to do with an intersection of many different European Union and US laws, including the Patriot Act, including anti-terrorism financing, FATCA, a lot of things that the US has in place. And also, once you move to Europe, you fall under European consumer protection laws, which are maybe a little bit above and beyond what the US has. The disclosure rules are very different for a bank or a financial institution when you purchase an ETF. Even something as simple as that people do every day on Fidelity, there's added disclosure in Europe. So what it means is that not every institution that holds your money is going to be comfortable with you coming to them and saying, hey, guess what? I'm moving to Italy in 2 weeks. They might say, oh, well, we need to run that up the compliance ladder. We need to talk to our lawyers. And so we see this relatively often where, people don't have any other kind of recourse. They're moving to Italy. They're breaking all their ties with the US. What do? So just be aware of that. If you have a pre-existing relationship you really like, just test the water. Say, hey, I'm thinking of spending some time in Italy. Word it in a very measured way. If you say I'm moving to Italy next week, you're going to get all kinds of different responses. If you say I'm thinking of spending some time there, usually you do that for your bank anyway, so that they know the transactions aren't fraudulent. It gives them some at least signposts to them. I've had the same credit union since I was 16. They couldn't care less where I live because I've had them since I was 16. So it depends on the institution and the relationship you have. I think that's it. All right.
So questions, if you want to talk to me. We'll get the shout out. Unless
Yeah.
come up with the mic.
You guys want to know him?
Sorry, say it again.
Yeah, so as you mentioned, muni bonds can be very tax efficient in the US. In California, they're everywhere. It's kind of like one of the first things you invest in. They are taxed as any other bond would be, any other interest income would be in Italy. So one thing to really consider with muni bonds is they usually pay a lower yield because they're tax efficient. And that lower yield comes back to bite you in Italy because they're not anymore tax efficient. They're looked at like any other bond. So really their net yield after tax is considerably lower than a normal bond. So it's really important to understand what's tax efficient in California is tax efficient in California and not really anywhere else a lot of the time. Anyone else? No? Yeah.
Yes, so he was asking about the FBAR, the foreign bank question. I had said that if you have $10,000 in foreign banks, you have to report it. So we asked if you have 10 different banks, how does it work? So in general, if all of your banks, if you find the maximum balance of each bank during the year, if the sum of all of those is above $10,000, you have to report every bank, right? So just to put some numbers out there, let's say you have 4 bank accounts. One of them has $3,000, another one has $3,000, and then the other one has $6,000. And the last one, the fourth one has 0, let's say. So that's a total of 12 in all. You have to report all of them, all of the banks, even the one with 0. So it's easier if you're in doubt, report it.
And to make it fun, it is actually the opposite for Italy, meaning Italy has a similar rule. When you live in Italy and you're an Italian tax resident, you have to report assets that you own overseas. However, Italy will look at each individual bank account balance. So if you have 10 bank accounts under the threshold, each of them under the threshold, you don't have to report any of them. So it's just a different approach that the two countries have. And the threshold depends if you are joint owner, the threshold gets doubled because it is considered per owner, and the threshold is different than the threshold adopted by in the U.S. And it is so complicated. We have information on the web. It would take me probably 10 minutes to explain it. Yeah, Italy has a tendency, Italian tax has a tendency of making things, fun, complicated. So, any other question? Oh, there was here a question. Do you wanna? There you go. There you go.
Hi, everyone. My dad recently got his citizenship through the jury sanguinis through your law firm, actually.
Okay.
And I wanted to get my citizenship through him. Do I have to wait until like May 28th to find out what happens with that? Because he wasn't born in Italy. So,
Okay.
that's my question.
Okay, so the question was about citizenship and yes, I would say definitely let's wait for another couple of weeks because there is an element of speculation at this point. Things might change dramatically. However, I'll be happy to talk more with you afterwards because it's very personal and specific. So yeah, I'll be very happy to do that. Okay, perfect. Yep.
Yes. Yeah, actually, that was something that you answered. Oh, so she said that I had said renting your house in the US has tax benefits in Italy.
Yeah.
And so take it away.
Yes. So I know that I talked about immigration. Let me see where the mic here is. So here it is. Kind of a fun game here too. So I talked a lot about immigration, but actually my area of focus is taxes. So that's a great question. So if you're planning to move to Italy and you are a property owner here in the US and you rent a home in the US, it's actually very good for tax purposes to consider continuing having that home in the US and renting it because Italy will consider as a taxable income the taxable income calculated based on the US tax code. So Italy has a completely different approach when it comes to rental income. Italy will tax you on your rental income for Italian rental properties on your gross rental income. In Italy, if you have an Italian rental income, you cannot deduct anything, almost anything. There are very few exceptions. However, if you have a rental income from the US, Italy will take the US taxable basis, which is very good because it will consider real costs like mortgage taxes, utilities, and also fictitious costs or like depreciation that you're not really really spending money for. So that's actually a great way of structuring your estate. Sometimes I will advise people to when they don't know what to do with their money to actually invest in US real estate because that makes sense. Also for immigration purposes, sometimes that helps. And yeah, so that was a very good question. Thank you. Okay, so the question is, okay, I'm renting in the US and I'm paying taxes on my rental in the US. What happens in Italy? As Alex said, the treaty against double taxation between Italy and the US establishes that the US has residence, so it gets to tax that income first, and then Italy will see how much did you get taxed in the US. If you got taxed less than what the Italian tax rate is, you in Italy will pay the difference, which is very rare because usually the write-offs in the US are so significant that, for example, sometimes I will advise a client, max out your equity, get a line of credit, like get a mortgage on that property and increase your costs on that property. And with that money, with that cash that you take out of the property, you lower through the interest, essentially, you lower your taxable income in the US. And with that money, you can do something else and you don't get taxed in Italy. So that's another option sometimes people go with. Do you have anything to add about from like the US tax code perspective?
I think all I would add is that it is one of the unique cases where a US you would get the foreign tax credit in reverse from what I talked about. You would get an Italian credit for the tax you paid in the US versus income that you earned while you're living in Italy. Anyone else? Any other questions? Or is it time to eat? I think it's time to eat then.
All right, thank you very much. Thank you.
Yes, thank you, everyone.
So, do you have the other part? Do you have the other part?
Yeah, thank you guys. We have everything should be set up outside if you want to join from Aperitivo. Because you have to get used to that anyway if you're moving to Italy. It's about that time. Thank you
there.
everybody for coming. Grazie mille.
Awesome. So, who gets this? Rowan? I'm going